We're joined today by Mitchell Kertzman, managing director at Hummer Winblad. He also founded PowerSoft back in 1974, so he's seen the tech world weather plenty of ups and downs over the years. I'm so glad you're here because we've been talking about this all day. How would a potential default affect the technology industry?
Well, probably indirectly, in the sense that the technology industry, if indeed the impact of a default would be a rise in interest rates, the tech industry is not quite as interest rate sensitive as maybe some other heavy equipment industries are, except that the tech industry's customers could be interest rate sensitive. And if they slowed down their buying, everything from consumers who may get mortgage interest rates raised and stop buying consumer electronics, to enterprise companies that may be leveraged and using debt to finance a big new data center. But it's really hard to know. You know, I spend a lot of time following the news on this and following people who in theory should be smarter about this than I am. And I don't think anybody really knows what might happen, except that it can't be good.
So if I don't buy the next iPad, or Google doesn't, buy another server, how does that have an impact on the corporations that sell those things? How big of an impact could there be there?
Well, it's unknown. I mean, if you look at it in macroeconomic terms, we have been recently through a significantly down macroeconomic cycle and recession in the country, and that impacted everybody top to bottom in the economy. So we invest in enterprise software companies. Their customers slowed their buying down quite a bit. And so a general macroeconomic downturn is going to affect everybody. I think it affects tech a little less, partly because tech broadly right now is in a very strong innovation cycle. There are genuine innovation cycles in technology, and we're in the early to middle part of a big innovation cycle with everything from what Apple is doing to what Facebook and Google and social and commerce. There's a lot of innovation going on in the tech economy right now, and that I think would dampen the negative effects because things aren't going to go to zero, despite what some people may fear.
Is tech more immune because it's funded by venture capital?
Well, to some extent, remember, we're in venture capital. We are long-term investors. So we're not doling out the money the way a bank might, for example, with a line of credit. So if you look at the news in venture capital, venture firms have been very active in funding private companies. And I would say, although there are exceptions, the tech industry is pretty well funded these days. And if there's a downturn, although venture-funded companies might slow down hiring and things like that just to preserve their cash, many of them have sufficient cash to continue to run their businesses and to innovate.
We've been talking a lot about whether there's a bubble or no bubble. There's clearly a lot of enthusiasm, as you say, in the technology sector and for innovation. Could the debt crisis potentially dampen that enthusiasm?
Well, it certainly could. For example, part of the enthusiasm now is around the fact that we're seeing a more robust IPO market. And the tech market, the venture-funded market, the private company market is very responsive to whether there's an exit market, particularly to IPOs. So if the debt crisis hit the public equities market hard and some good companies couldn't get their IPOs done, then that would eventually have a dampening effect on valuations for private companies. But it's somewhat accordion-like. In other words, this market doesn't respond instantly the way the public equities market would. These companies, except for the rare ones on the secondary markets, they're not traded every day. They don't get valued every day.
So is this something that you as a venture capitalist are concerned about?
Candidly, it's something I'm far more concerned about as a citizen than I am as a venture capitalist. I'm appalled as a citizen at what I see going on in Washington. As a venture capitalist, I do worry about the economic climate. All of our companies are sensitive to it, but we are early stage, long-term investors. So that says that we invest with the idea that economic cycles may happen during the lifetime of our investment, and that's a natural part of the business. And so we tend to worry about it, not so much about our own investing, but about whether our companies are finding customers who are willing to pay for their products.
How about tech M&A? Could that be impacted?
Sure. To the extent, particularly, that companies use debt to finance particularly larger M&A transactions, that could be impacted by a higher cost of capital. Although, if you look at the large companies that are tech acquirers are pretty flush with cash these days. So it's hard to say, if things fall apart significantly, everything will get affected. I do not believe that we're going to see that. I really don't believe that even if we hit a technical default next week, that people really think that the United States is Greece or Portugal, that we really risk defaulting on our obligations. I think people think we have a political malfunction rather than a financial malfunction.
And I think a lot of citizens would agree with you if you look at the Twitter feeds out there. Mitch Kertzman of Hummer Winblad, thanks so much for joining us. This is something we're definitely going to continue to follow, and it's very interesting to hear your thoughts.
Thanks for having me.